Topic explains the effects of monetary policy on the economy and the limitations central banks face when implementing policy decisions. Monetary policy influences aggregate demand primarily through changes in interest rates, money supply, and credit availability. Expansionary monetary policy lowers interest rates and increases liquidity to stimulate economic growth, while contractionary policy raises rates and restricts liquidity to control inflation. These actions affect borrowing, investment, consumption, employment, and exchange rates throughout the economy. Because monetary policy significantly influences financial markets and economic conditions, investors and analysts closely monitor central bank decisions to evaluate future economic growth, inflation trends, and asset price movements. One of the primary effects of expansionary monetary policy is increased economic activity. Lower interest rates reduce borrowing costs for households and businesses, encouraging consumer spending, housing purchases, and corporate investment. As aggregate demand rises, firms often increase production and employment, supporting economic recovery during recessions. Lower rates also tend to raise asset prices because investors seek higher returns in equities and other risk assets when fixed income yields decline. However, if expansionary policy remains excessively loose for too long, inflationary pressures may emerge as demand exceeds productive capacity. Central banks therefore must carefully balance economic stimulation with the need to maintain long-term price stability and sustainable growth. Contractionary monetary policy has the opposite effect by slowing economic activity and reducing inflationary pressure. Higher policy interest rates increase borrowing costs, discourage excessive credit growth, and reduce consumer and business spending. Slower demand growth helps moderate inflation when the economy is overheating. Tightening monetary policy may also strengthen a country's currency because higher interest rates attract foreign investment seeking better returns. However, aggressive tightening can reduce economic growth too sharply, increase unemployment, and negatively affect financial markets. Equity valuations often decline as higher discount rates reduce present values of future earnings. Investors therefore monitor central bank tightening cycles carefully because monetary restrictions significantly influence bond yields, stock performance, and economic expectations. The monetary transmission mechanism describes how policy changes spread through the economy. Central bank actions initially affect short-term interest rates and banking system liquidity. These changes influence commercial lending rates, credit availability, investment decisions, and consumer spending behavior. Exchange rates may also adjust as capital flows respond to changing interest rate differentials between countries. For example, lower interest rates can weaken a currency by reducing foreign demand for domestic assets, potentially improving export competitiveness. Asset prices also respond because changes in interest rates alter discount rates and investor risk preferences. Understanding the transmission mechanism helps analysts evaluate how monetary policy affects different sectors, industries, and asset classes over time. Despite its importance, monetary policy faces several limitations. One major challenge is the existence of time lags between policy implementation and economic impact. It may take months or even years for interest rate changes to fully influence borrowing, spending, and inflation. Central banks also have limited ability to stimulate demand during severe recessions if consumers and businesses remain unwilling to borrow despite low rates. This situation, often referred to as a liquidity trap, weakens policy effectiveness. Additionally, monetary policy may be less effective when financial institutions are reluctant to lend or when structural economic problems limit growth. External shocks, global economic conditions, and political uncertainty can further reduce the effectiveness of domestic monetary actions. Overall, topic highlights both the power and limitations of monetary policy in managing economic conditions. Expansionary and contractionary policies influence inflation, employment, growth, exchange rates, and financial markets through complex transmission channels. While central banks play a vital role in stabilizing economies, policy outcomes are not always immediate or predictable because of implementation lags, behavioral responses, and structural constraints. For CFA candidates, understanding monetary policy effects and limitations is essential because central bank actions directly affect interest rates, bond prices, corporate profitability, and investor expectations. Strong monetary analysis therefore improves macroeconomic forecasting, risk management, and investment decision-making across changing economic and market environments.